Millions of people just signed up to own a piece of a rocket company. Most of them had never bought an IPO in their lives. They opened apps they'd never used. They waited in digital lines for 2 days straight. And for one electric moment, they felt like they'd finally made it into the room where the big money actually plays. Here's the number that should stop you cold. SpaceX set aside up to 30% of its offering for everyday investors. The normal share for retail in a deal like this is 5, maybe 10%. So this looked like generosity. It looked like the little guy finally getting a seat. It wasn't generosity. It was structural. It was engineered. By the end of this video, you'll know one specific date. Write it down the second you hear it. Because that single date changes how you look at every hot IPO for the rest of your investing life. I'm going to do something the headlines never bothered to do. I read the actual filing. The prospectus SpaceX submitted to the SEC, the 400-page document that almost nobody scrolls through. While the news ran countdown clocks and slow-motion rocket footage, the real story was sitting quietly in the fine print of the lockup schedule. That's where the machine lives. Not in the launch pad. In the legal language about who is allowed to sell, how much, and exactly when. Stick with me for the next few minutes, and you'll start reading this market the way the people who designed it read it. Think about a lottery for a second. Not the dream of winning, the mechanics underneath it. Somebody printed the ticket. Somebody calculated the odds long before you ever walked into the store. The prize is real. People genuinely win, and you've seen their faces on the news. But the entire system was engineered by the people selling the tickets. And nobody prints lottery tickets hoping to lose money. An IPO runs on the same logic. The shares are real. The company is real. SpaceX, by any honest measure, is an extraordinary business. But the offering itself, the structure, the timing, the rules about who exits and when, that part was printed by the House. And the House never prints a ticket designed to pay out to you. It prints the ticket designed to pay out to itself and lets you feel lucky for holding one. Let me be completely clear about what this video is not. This is not me telling you SpaceX is a bad company. That argument would be stupid, and you'd be right to close the tab on me. SpaceX pulled in $18.7 billion in revenue in 2025. Its connectivity segment, led by Starlink, did $11.4 billion. Launch brought in another $4.1. The AI division added more on top. This is not a meme stock with a logo and a prayer. This is one of the most important companies on the entire planet, and it's not close. So the question is not whether it's a good company. The question is the one almost nobody says out loud. At what price and who exactly was this offering built for? Because a great company and a great deal for you are not the same sentence. They're not even in the same paragraph. Let me introduce you to someone. We'll call him Marcus, 27 years old, software developer, lives in Austin, decent salary, no real investing history beyond his 401k. Marcus saw the IPO explode across his feed in May 2026. Every finance creator he followed was talking about it day after day. He'd never bought an IPO before in his life. But this one felt different. This one felt historic. This felt like the thing people would ask him about in 10 years. Were you in, or did you watch? So Marcus did something he'd never done. He opened a brand new brokerage account specifically for this one deal. He sat in a waitlist queue for 2 full days, refreshing. And he got in. 15 shares at $135 each. A little over $2,000. For the first time in his life, Marcus felt like he was standing shoulder to shoulder with the hedge funds. Same price. Same deal. Same table. Or so it seemed. Hold on to Marcus. We're going to come back to him 3 times. And what happens to him is the entire point of this video. Because here's the thesis I'm going to prove to you, line by line. Retail doesn't buy the IPO. Retail buys the exit. Open the app. Watch SPCX for 10 minutes. Red. Then green. Then greener. Every tick on that chart feels like fresh proof that something enormous is happening right now, without you while you sit there doing nothing. Your thumb starts hovering over the buy button. The candles are basically screaming that you're already late, that the train left, that everyone but you figured this out. That feeling, that specific physical stomach-level urgency, is not an accident. It was manufactured on purpose. And the tool that manufactured it has a name. It's called float. Here's the mechanism, plain. Float is the slice of a company's shares that are actually free to trade on the open market. Not locked up. Not held hostage by insiders. Actually buyable right now, today, by a person like you. SpaceX sold roughly 555 million shares in the offering. That sounds like an ocean of stock. But that's only about 4.3% of the entire company. The other 95.7%? Locked away. Not for sale. Not yet. Held by founders, employees, and early investors who are all waiting for their turn at the door. Sit with that for 1 second. The entire frenzy you're watching, the whole price discovery for a company valued at $1.77 trillion, is happening on a sliver smaller than 4.5% of the shares. Let me make it concrete with real money. Say you've got $1,000 and you decide to jump in. At $135 a share, that buys you about 7 shares. Fine. Now picture millions of people doing the exact same thing, on the exact same morning, through Robinhood, through SoFi, through every app with a $0 minimum and a confetti animation. All of them reaching their hands into the same tiny pool of available stock at the same time. When demand is enormous and supply is deliberately microscopic, the price does not drift gently upward. It launches. Every single buy order shoves it higher, because there's almost nothing on the other side to absorb the pressure. A normal stock can take your order without flinching. This one can't. This one was built thin. And here is the turn. The scarcity isn't in the company at all. SpaceX has plenty of shares, 13 billion of them sitting right there. The scarcity is in the design. Someone sat in a room and decided exactly how thin to slice the public offering, knowing precisely what that thinness does to price and to the person staring at the chart. So why does it work on you specifically? Because scarcity hijacks a circuit in your brain that is far older than money. When something looks rare, and you can see other people lunging for it, your nervous system flips into grab-it-now mode before your reasoning has even finished booting up. That's not a personal weakness. That's standard-issue human wiring, the same instinct that kept your ancestors alive. The float wasn't designed in spite of that wiring. It was calibrated to pull exactly that trigger. So here's how it shows up in your real life. It's the Tuesday night you refresh the price 6 times before bed, telling yourself you'll decide in the morning, while knowing somewhere underneath that the scarcity is already doing your deciding for you. But the float, as ugly as it is, isn't even the strangest part of this. Something happened at NASDAQ in May 2026 that almost no one in the media covered. And it tied your retirement account directly to this rocket company, whether or not you ever once clicked buy. You probably have a 401k, maybe an IRA on the side, maybe just a target date fund your employer quietly picked for you the day you got hired. And you have never, not once, voted to put SpaceX inside it. You may have never even thought about SpaceX as an investment before this year. It's in there now, or it's about to be, and nobody asked you. Here's what happened, and this is the part that almost nobody explained in plain English. In May 2026, NASDAQ rewrote its own rulebook. They rolled out something called the fast entry rule. Under the old system, a newly public company had to wait, sometimes months, sometimes all the way until a scheduled rebalance, before it could be added to the NASDAQ 100. Under the new rule, a giant new listing ranked in the top 40 by size can be added after just 15 trading days. 15 days. That is the speed at which every single index fund tracking the NASDAQ 100, including the QQQ, one of the largest ETFs on the face of the earth, becomes obligated to go out and buy SpaceX. Not because a portfolio manager studied the numbers and believed, because the rulebook left them no choice. Now stack a second rule change right on top of the first one. NASDAQ also rewrote how it weights companies that have very little float. Under the old rules, there was a floor. You needed at least 10% of your shares freely trading to be included the normal way. They scrapped that floor entirely. Gone. In its place, they installed a multiplier. For a company with float below 33%, the index now treats it as if its float were up to 3 times larger than it actually is. Run that math on SpaceX. Real float, 4.3%. Multiply by 3. The index now behaves as though the float is 12.9%. It weights the stock as if more than 3 times as much of it were available to buy than truly exists in the wild. Let me translate that consequence into dollars, because the abstraction hides the violence of it. The QQQ alone manages hundreds of billions of dollars. When a stock gets added to that index at an inflated, multiplied weight, no less, the fund must buy its proportional slice. And it cannot care about the price. An index fund is a price-blind buyer by design. That's the whole product. It buys what the formula tells it to buy, at whatever price the market happens to be asking, on the day the rule says to buy it. So now picture the collision. On one side, billions of dollars of forced, mechanical, price-blind buying pouring in on a fixed schedule. On the other side, that same anemic 4% float. An ocean of mandatory demand crashing straight into a puddle of supply. That doesn't guarantee the price only goes up. Sellers, arbitrage, and liquidity all push back. But it stacks heavy, one-sided pressure onto the thinnest part of the market. Your index fund didn't buy SpaceX because it loved the valuation. It bought because the rulebook left it no way out. That isn't investing. That's plumbing. Water flows where the pipe sends it, and somebody redrew the pipe in May. And here's how it shows up in your real life. It's the moment you open your retirement app, watch the balance tick up a little, and feel quietly good about yourself, never realizing that a slice of that number is a forced, price-blind bet, a rule change made on your behalf, into the thinnest float on the market. Let's go back to Marcus. Now imagine it's March 2027, 9 months after the IPO. Marcus is on his couch with the app open, and he's doing something he never did back in May. He's reading the calendar, because something just happened. The first big tranche of locked shares came unlocked. Tied to the company's quarterly earnings release, around 20% of previously restricted stock suddenly became eligible to sell. And say a major unlock pulls the price down sharply in a matter of days, right after that release. Marcus is still above his entry of 135. Still green, just barely. But for the first time since this whole thing started, he is not looking at the chart. He's looking at the schedule. And what he sees printed there isn't a price. It's a staircase. This is the mechanism. The lockup. When a company goes public, the insiders, employees, early investors, the founders themselves, agree not to sell their shares for a set period after the IPO. The textbook version is 180 days. One cliff. Everyone released at the same moment. SpaceX did not do that. SpaceX built a cascade. Open the filing and you find a whole staircase of release dates, each one carefully placed. Roughly 7% of shares unlock on day 70. More on day 90. More on day 105. Then day 120. Then day 135. And then the bigger waves arrive, around 20% and then 28%, deliberately tied to the second and third quarter earnings releases. Each step pours more supply into that same tiny float, on a precise, pre-printed schedule. The insiders are not trapped by this lockup. They're being walked to the exit, one orderly step at a time, while the index funds keep their price-blind buying machine running underneath them. It's a conveyor belt, and you're standing at the bottom of it with your hands out. And then there is the single cruelest line in the entire document. There's a performance trigger. If the stock trades at least 30% above the IPO price for 5 out of 10 days around the earnings date, the insiders are allowed to release an extra 10% of shares early. Read that one more time and let it land. If retail holds the price up high, the insiders are rewarded with the right to sell even more, even faster. Your enthusiasm does not protect your investment. Your enthusiasm accelerates their exit. You holding the line is the thing that opens the door for them. This is the whole thesis of this video in a single sentence. Retail doesn't buy the IPO. Retail buys the exit. And this is not theory. We have watched this exact movie before. When Rivian's lockup came due back in 2022, the stock dropped roughly 20% in a single day after word got out that a major holder intended to sell its stake. Uber hit its all-time low the very week its lockup expired, landing about 40% below the price it went public at. The academic record backs it up cold. A landmark study by Field and Hanke, published in the Journal of Finance, examined nearly 2,000 lockup agreements. They found that when the locks expired, trading volume jumped a permanent 40%, and the stock took a clear, measurable negative hit in the 3 days surrounding the unlock. This is not a hunch. This is a pattern with a paper trail decades long, sitting in one of the most respected journals in the field. Now here's the date Marcus finally circled in red on his calendar. One date stands completely apart from all the others. Elon Musk's shares, 6.4 billion of them, sit under a lockup of 366 days. No early release, no performance trigger, no staircase. One single date, June 12, 2027. The day the largest single block of stock in the entire company becomes legally free to move. Marcus had never once done the math on how many times the entire public offering that one block of shares represents, about 11.5 times it. When he finally did, he put the phone down. You wake up, you grab your phone before you're even fully conscious, and SpaceX has already opened about 11% above the IPO price. Your stomach does the thing. And you buy anyway because in your head you still got in early. The company's only been public for a few hours. How late could you possibly be? Late enough. And the number that proves it is one of the most studied facts in all of finance. It's called the IPO pop. The first day jump. Jay Ritter, a finance professor at the University of Florida who has tracked this phenomenon for decades, found that IPOs from 2012 to 2021 popped an average of about 23.5% on day one. Here's what that number actually means, and it is not the good news it sounds like. That pop is a gift, but it's a gift handed to whoever bought at the offering price. The institutions, the insiders, the lucky few who got an allocation before the market opened. By the time the stock opens to the public, to you, the pop has already happened. The value already transferred. You are not catching the rocket on the launch pad. You're paying full fare for a seat after it's already 1,000 feet in the air, and calling it a head start. That's not a statistic on a screen. That's the difference between buying $1 for $1 and buying that same dollar for $1.23, while telling yourself the whole time that you found a deal. And then there is the price itself, which is its own separate problem. SpaceX went public at a valuation of around $1.77 trillion, against $18.7 billion in revenue. Do that one division and you get a price-to-sales multiple of roughly 94. 94 times revenue. Not earnings, revenue. For context, the S&P 500 as a whole trades somewhere around 3.5 to 4 times revenue, according to analysts at the Motley Fool. So SpaceX came public priced at more than 25 times the typical multiple of the entire broad American stock market. And remember the other detail, the one that gets lost in the excitement. This is a company that, for all its genuine brilliance, posted a net loss of nearly $5 billion in 2025. You are paying 94 times sales for a business that is currently losing money. Let me make that multiple real so it isn't just a scary number. For a 94 times revenue price to ever look reasonable, SpaceX would have to grow its revenue many times over, and then keep growing fast, for years without a single serious stumble, all at the scale of $1 trillion company. It might actually do it. This company has done impossible things before, and only a fool bets against the engineering. But understand the deal you're taking. You are paying today in full up front for a decade of flawless execution that has not happened yet and is not guaranteed to anyone. And one last detail that tells you everything. They reserved up to 30% of the offering for retail. Then, quietly, before the open, they trimmed it down to the low 20s. That wasn't charity, and the trim wasn't an accident either. That was calibration. Enough retail in the deal to drive the price up. Not so much retail that they ever lost control of it. You were an ingredient measured to spec. So here's how it shows up in your real life. It's the screenshot you fire off to the group chat the morning it opens green, the one where you finally feel like the smart one in the chat, about 8 months before the calendar quietly does what calendars always do. Now let me argue against myself for a minute because you deserve the honest version, not just the cynical one. SpaceX might genuinely grow into this valuation. I'm not being sarcastic. Starlink at $11.4 billion and climbing is a real, recurring, global subscription business with very few true competitors. Launch dominance is real and getting more entrenched, not less. If this company manages to triple or quadruple its revenue over the next several years, which is genuinely not a crazy thing to imagine for this particular company, then somewhere out around 2031, that terrifying 94 multiple starts to look merely expensive instead of completely insane. And the early people, the ones who bought at the offering price, some of them are going to do extraordinarily well. The lottery does pay out. Real people do win it. That part is completely true, and I'm not going to pretend otherwise to make my point cleaner. So I am not telling you the company is going to fail. I'm telling you something far more useful than a prediction. The question was never whether SpaceX is a good company. The question is whether the timing and the structure of this specific offering, the thin float, the rewritten index rules, the lockup cascade, the 94 multiple, were built to serve the person buying on their phone the morning it opened. They weren't. They were built to serve whoever holds the lockup schedule. And here's the part that's genuinely hard to hold in your head at the same time. The company can succeed wildly, and you can still have badly overpaid for the exact moment you chose to buy. Both of those things are allowed to be true at once. Wall Street has always been perfectly comfortable living inside that contradiction. Starting today, so can you. All right, you know exactly how this machine works now, top to bottom. Here's what that actually changes for you in concrete terms. First, if you genuinely want to own SpaceX for the long term, not as a lottery ticket but as a real investment you intend to hold, understand that the most informed price you will ever get to see comes after the float becomes real. Watch that staircase of lockup dates. And pay specific, close attention to the big one, the day the largest blocks finally come unlocked and the true supply hits the market. The supply schedule will tell you more about the honest price than the hype ever could. Patience here is not weakness. It's information. Second, if your index fund has already placed you into SpaceX through the back door we talked about, you do not need to panic sell, and you do not need to chase more on top of it. You are already exposed. There is a real, meaningful difference between being calmly invested through a diversified fund and frantically buying individual shares because a green candle scared you into it. Knowing that you're already in is not a reason to double down. It's a reason to relax. Third, and this one outlives SpaceX entirely, this is the part to actually keep. The next hot IPO is coming. There is always a next one. And before you ever open the app, before you ever feel that thumb-hovering urgency again, find the lockup expiration date. It is sitting right there in the filing. It is public. It is free. It is the single most useful number that nobody ever bothers to put in the headline. When the locks lift, supply floods in, and the price often follows it down. Now you're the person who thought to look. That is the exit Marcus eventually found. It wasn't a panic. It wasn't a hot tip. It was a date. So remember that date I told you to write down at the very beginning of this video? Here it is. June 12, 2027. The day 6.4 billion shares, Elon Musk's entire personal stake, come legally free. Mark it on something. Because how a stock behaves around its single biggest unlock tells you, more honestly than any earnings call, who the offering was really built for all along. Let's close the loop on Marcus one last time. He didn't panic sell back in March. He didn't post a screenshot of red numbers and rage at the company either. But he did make a quiet decision, sitting on that couch with the calendar finally open in front of him. If he wanted SpaceX for the long haul, he would buy after June 2027, after the real float was discovered, after the biggest block had its day in the open market, and not a single moment before. He kept his 15 shares. He just stopped adding to them on hype. He stopped being the exit. He started being patient, which on Wall Street is almost the same thing as being smart. He started thinking like the insider without ever having to become one. Same brain he always had. Same $2,000. A completely different seat at the table, and he never had to move chairs to get it. He just learned to read the schedule. Because that's the whole thing in the end, isn't it? The rocket is real. The company is real. The ambition is real and it's magnificent. But the offering was a machine. The machine had a purpose. And the purpose was never, at any point, you. Retail doesn't buy the IPO. Retail buys the exit. Unless you know the date. Now go find the date on the next one. That right there is the entire game.